Inflation is a sneaky thief. It quietly erodes the value of your hard-earned money without you even noticing. Every year, the cost of goods and services tends to rise, meaning the same amount of money buys you less and less. It steals the value of your money over time. Imagine you have $100 today. If inflation is at 3% in a year, your $100 will only have the purchasing power of $97. What you could buy for $10 today might cost $12 next year. This means that the same amount of money buys fewer goods and services as time goes on. This means your money is buying less. It's losing purchasing power. You might find yourself needing more money to maintain the same lifestyle or to buy the same items you used to. Investing is the key to fighting inflation. By putting your money into investments, you can potentially earn returns that outpace inflation. When you invest, you put your money to work. Instead of just sitting in a savings account, your money can grow through interest, dividends, or capital gains. Your money can grow faster than inflation. Over time, this growth can significantly increase your wealth. This helps you build wealth and reach your financial goals. Whether it's buying a home, funding your children's education, or planning for retirement, investing can help you achieve these milestones. Think of it like this. Imagine you have a garden. If you plant seeds and take care of them, they will grow into plants that bear fruit. Imagine you bury $100 in your backyard. If you just leave it there, it won't grow or change. A year later, you dig it up. You still have $100, but it hasn't grown or increased in value. You still have $100, right? But because of inflation, that $100 might only buy you $95 worth of stuff now. But because of inflation, that $100 might only buy you $95 worth of stuff now. This is why it's crucial to invest and grow your money. Investing helps you stay ahead of that sneaky thief, inflation. By earning returns on your investments, you can preserve and even increase your purchasing power. It's how you make your money work harder for you. Instead of losing value, your money can grow and help you achieve your financial dreams. When you buy a stock, you're buying a small piece of a company. You become a part owner, even if it's a tiny part. This ownership is represented by shares of stock. Stocks can make you money in two ways. The first way is through price appreciation. This means the stock's price goes up. You buy low and sell high. The second way is through dividends. Companies share profits with their stockholders. These payments are called dividends. Remember, stock prices can go down too. Investing in stocks always carries risk. It's important to do your research and invest wisely. Index funds are like baskets of stocks. Imagine you have a basket filled with a variety of fruits. If one fruit goes bad, you still have plenty of good ones left. Similarly, index funds hold a variety of stocks. So if one stock performs poorly, others can help balance it out. They track a specific market index. This means they mirror the performance of a particular segment of the market, providing a broad exposure to that segment. One example is the S&P 500. This index is widely regarded as a benchmark for the overall US stock market. This index includes 500 of the largest US companies. These companies span various industries from technology to healthcare, providing a diversified investment. When you buy an S&P 500 index fund, you own a small piece of all those companies. This is called diversification. Diversification reduces your risk. By spreading your investments across many companies, you are less likely to be severely impacted by the poor performance of a single company. If one company does poorly, others can balance it out. This balance is key to maintaining a stable investment portfolio. Index funds are great for beginners. They offer a straightforward way to start investing without needing to pick individual stocks. They offer a simple way to invest in the stock market. With just one purchase, you can gain exposure to a wide range of companies. They are also very low cost. Index funds typically have lower fees compared to actively managed funds because they simply track an index rather than trying to outperform it. This means more of your money goes towards growing your investments. Over time, these savings on fees can add up significantly, boosting your overall returns. Remember, investing in index funds is a long-term strategy. Patience is key, as the market can be volatile in the short term but tends to grow over the long term. It's not about getting rich quick. Avoid the temptation of high-risk investments that promise quick returns but come with significant risks. It's about steady, consistent growth over time. By staying invested and regularly contributing to your index funds, you can build wealth gradually and securely. Many people try to beat the market. They try to pick individual stocks that will go up in price. But consistently picking winners is really hard. Even professional investors struggle to do it. Index funds take the guesswork out of investing. They simply track the market. Over the long term, the market tends to go up. This means index funds have the potential to provide solid returns. Think of it like a marathon. Some runners might sprint ahead at the start, but it's the steady, consistent runners who usually win the race. Index funds are like those steady runners. Index funds won't make you rich overnight, but they offer a reliable path to building wealth over the long haul. Section 5. Getting started. Investing in index funds. Investing in index funds is easier than you might think. With the rise of technology and online platforms, the process has become incredibly streamlined and user-friendly. You don't need to be a financial expert to get started. You can do it all online. From researching different funds to making your first investment, everything can be done from the comfort of your home. This convenience has opened up investing to a much broader audience. First, you need to open an account with a brokerage firm. This is your gateway to the world of investing. The process is usually straightforward and involves filling out some basic information about yourself. There are many to choose from, like Fidelity, which is known for its robust research tools and customer service, Schwab, which offers a wide range of investment options and low fees, or Vanguard, famous for its low-cost index funds and long-term investment philosophy. Once you have an account, you can choose the index fund you want to invest in. Index funds are designed to track the performance of a specific market index, like the S&P 500, which includes 500 of the largest companies in the US. For example, you might choose an S&P 500 index fund. This type of fund aims to mirror the performance of the S&P 500, providing you with a diversified portfolio of large-cap stocks. Then you simply decide how much money you want to invest. It's important to consider your financial goals and risk tolerance when making this decision. Start with an amount you're comfortable with. You can even set up automatic investments. This feature allows you to invest a fixed amount of money at regular intervals, such as monthly. It's a great way to ensure you stay consistent with your investing. This means money is automatically transferred from your bank account to your investment account each month. It's a convenient way to build your investment portfolio without having to remember to make manual transfers. Remember, it's important to start small and gradually increase your investments over time. This approach helps you get comfortable with the process and reduces the risk of making large, impulsive investments. Even investing a little bit each month can make a big difference in the long run. The power of compounding means that your investments can grow significantly over time, turning small contributions into substantial savings. Section 6. Riding the roller coaster, navigating market volatility. The stock market goes up and down. It's like a roller coaster. There will be good times and bad times. Don't panic when the market dips. This is normal. Market downturns are a natural part of investing. What matters is how you react to them. Try to stay calm and stick to your long-term plan. Don't make rash decisions based on fear. Remember, time is your friend when it comes to investing. The longer you stay invested, the more time you have to ride out those market fluctuations. Section 7. Slow and steady versus fast-track paths to wealth. There are two main paths to building wealth. The first is the slow and steady lane. This involves traditional methods like saving money and investing in index funds. The second path is the fast track. This involves finding ways to increase your income more rapidly, like developing high-income skills or starting a business. Both paths have their merits. The slow and steady lane is like a marathon. It requires patience and discipline. The fast track is more like a sprint. It requires hustle and risk-taking. The best path for you depends on your individual circumstances, risk tolerance, and financial goals. Section 8. Shifting gears. High-income skills and business ventures. If you're looking to accelerate your wealth-building journey, consider developing high-income skills or starting a business. These paths offer the potential for higher earning potential. High-income skills are in high demand. Think about fields like technology, healthcare, or finance. These skills can lead to lucrative careers. Starting a business is another way to take control of your income. It could be something you're passionate about. It could be a side hustle that grows into something bigger. Remember, success in these areas requires hard work, dedication, and a willingness to learn and adapt. Section 9. Never stop learning resources for investment success. The world of investing is constantly evolving. There's always something new to learn. Luckily, there are tons of resources available to help you. You can read books, listen to podcasts, or take online courses. Seek out reputable sources and financial experts who align with your values. Don't be afraid to ask questions. Talk to financial advisors or experienced investors. The more you learn, the more confident you'll become in your investment decisions. Remember, investing in your financial education is one of the best investments you can make. It empowers you to make informed decisions and build a secure financial future.